I've always been fascinated by the stories that history whispers. Stories of triumph, of disaster, and of timeless lessons that seem to echo louder as the years go by. And among these, few lessons are as urgent, as necessary, as the warnings that Benjamin Graham left behind. Today, I want to take you on a journey into the world of hot stocks, speculative mania, and the perils that have destroyed countless portfolios. I want to show you why, even decades after Graham first put pen to paper, investors continue to fall into the same traps. Picture the roaring 1920s. The streets of New York buzzed with energy. Stock tickers clicked tirelessly, and the promise of instant wealth seemed within reach for anyone who dared to buy at the right moment. Everyone was talking about the next big company, the stock that would double overnight. People who had never considered investing before were lining up to throw money at ideas they barely understood. The air was intoxicating, electric with ambition. And yet, beneath the glittering surface, Graham saw the dangers clearly. He saw investors hypnotized by price movements, captivated by the idea of hot opportunities, and oblivious to the fundamentals that should have guided their decisions. And this, he warned, was where wealth could vanish as quickly as it appeared. Not because the companies themselves were always failures, but because the frenzy around them ignored one simple yet profound principle: value. The intrinsic worth of a company, its assets, its earnings, its ability to survive adversity, mattered far more than the noise of the market or the excitement of the crowd. Graham understood, in a way that few of his contemporaries did, that speculation is seductive, and that hot stocks, while glamorous, carry a hidden cost that is all too often paid in full by the naive or overly ambitious investor. Fast forward to today, and the story feels eerily familiar. Headlines scream about the next viral stock. Social media amplifies every rumor, every trend. Investors are again seduced by the siren call of rapid gains, forgetting the cautionary tales of history. It's tempting to think that times have changed, that new technologies or global markets protect us from the mistakes of the past. But the human psyche remains constant. Greed, fear, and the desire to belong have always guided investors as much as logic and research. And Graham's voice, steady and unwavering, reminds us that the fundamentals have not changed either. The same rules that protected investors in the 1930s are the same rules that protect us today. In this video, we will explore why hot stocks are so dangerous, how the allure of immediate wealth can blind even the most intelligent investors, and, most importantly, how Graham's timeless principles can shield us from the mistakes that history has already documented. We will travel back to the speculative highs of the 1920s, witness the crash that followed, and draw lessons that are startlingly relevant in today's market. You will come to understand that true investing is not about chasing excitement, but about patience, discipline, and the quiet pursuit of value. And as we dive deeper, you will see why ignoring these warnings is not just risky, it is almost a guarantee that a portfolio will suffer. But what happened next, in the months and years following the market's euphoria, would challenge everything even Graham believed about the resilience of human optimism and the fragility of wealth.
I often imagine Benjamin Graham in his office, poring over balance sheets, earnings reports, and the constant chatter of the ticker tape outside his window. By the late 1920s, Graham had already distinguished himself as a keen observer of markets, not merely a participant. He had seen investors intoxicated by price movements, buying not because a company had solid earnings or a strong balance sheet, but because everyone else seemed to be buying. The lesson was simple, yet profound. Popularity does not equal value. In those years, speculative bubbles were not the exception, they were the rule. Investors rushed into companies with fanciful promises, their decisions driven by emotion rather than analysis. Graham often recounted observing these trends and recognizing the patterns of human behavior that fueled them. The mania was unmistakable. The rapid rise of stock prices disconnected from underlying economic reality, the herd mentality, and the fragile belief that prices could only go up. He understood that these cycles were perilous, and he saw that wealth built on speculation was precarious at best. Take, for example, the rise of utility and holding companies in the 1920s. They were the hot stocks of the era, lauded for their rapid gains and the allure of dividends that seemed too good to be true. Many investors failed to scrutinize the company's actual earnings or debt levels, choosing instead to ride the wave of excitement. Graham observed how a lack of critical analysis, coupled with the social pressure to participate, often led investors into positions that were incredibly risky, despite appearing safe on the surface. Graham's genius lay not only in recognizing the danger, but in formulating practical methods to avoid it. He advocated for what he would later formalize as the principle of the margin of safety, insisting that investors should never pay for a security than its intrinsic value justified. This idea was revolutionary at a time when the prevailing sentiment was that the market could do no wrong and that rising stock prices were proof of intelligence and foresight. As the speculative frenzy peaked, Graham witnessed firsthand the fragility of human optimism. The crash of 1929, which many thought would never come, illustrated precisely what he had feared. When reality and speculation collided, the consequences were devastating. Companies with questionable fundamentals collapsed, and investors who had ignored the principles of value lost fortunes. Even today, the echoes of those lessons are clear. When we see a stock go viral on social media or hear stories of friends doubling their money overnight, it is easy to forget that the underlying principles remain the same. Popularity and hype cannot replace diligent research. Graham's early encounters with speculation taught him, and by extension, us, that the path to sustainable wealth is not paved with excitement or luck, but with careful, disciplined evaluation. And yet, the challenge is not merely identifying the risk, it is resisting it. For what tempted Graham's contemporaries then still tempts investors now. The seductive thrill of hot stocks promising rapid rewards for those willing to ignore caution. But as we will see in the next segment, the human appetite for speculation can blind even the most disciplined, making the lessons of the past as vital today as they were nearly a century ago. When we speak of hot stocks, Graham's cautionary voice resonates across time. In his day, a hot stock was defined not by earnings, dividends, or intrinsic value. It was defined by excitement. It was the stock everyone was talking about, the one rising daily in price, seemingly impervious to reason. But Graham understood that the allure of these stocks was deceptive. They were not investments. They were speculation, dressed in the language of opportunity.
Consider the patterns he observed. Hot stocks often shared common traits: a rapid price surge with little fundamental justification, stories in newspapers glorifying their performance, and a swelling crowd of buyers driven more by fear of missing out than by analysis. These traits are timeless. Today, we see them in tech bubbles, meme stock phenomena, and even in cryptocurrencies. The psychology is identical. Humans are wired to follow trends, often at the expense of rational judgment. Graham dissected the anatomy of these stocks with meticulous precision. First, he examined their earnings, or lack thereof. Many hot stocks of his era reported impressive top-line revenue growth, but their net income told a different story. High leverage, inflated asset valuations, and creative accounting masked their true financial health. A company might seem profitable on paper, yet behind the scenes it teetered on the brink of insolvency. Second, Graham studied market behavior. Hot stocks often moved independently of economic reality. While other investments might fluctuate modestly in line with business performance, hot stocks were wildly volatile. Prices soared on optimism and collapsed on rumors or minor setbacks. The risk was not always obvious because investors were enchanted by stories of rapid gains, forgetting that markets could reverse just as quickly. Third, he observed investor psychology. When a stock was hot, caution vanished. Even seasoned investors succumbed to the pressure to participate. Everyone else is making money, they thought. Graham recognized this as the danger of the herd mentality, the belief that collective enthusiasm could justify price, even when fundamentals did not. He warned that wealth built in such conditions was fragile, always at the mercy of sentiment rather than substance. The lesson for the defensive investor is clear. Understanding the anatomy of a hot stock is the first step in avoiding its pitfalls. It is not enough to look at past gains or anecdotal success stories. One must investigate the underlying business, scrutinize the balance sheet, and evaluate whether the price truly reflects value. If it does not, no amount of hype can transform a poor investment into a safe one. Graham also emphasized that avoiding hot stocks is not passive avoidance. It is a proactive strategy. By steering clear of speculative excitement, the defensive investor can focus on stable companies with predictable earnings, strong balance sheets, and dividends that reflect real economic performance. These are the investments that withstand the cycles of fear and greed, delivering steady returns over time. Yet, avoidance alone is not the entire answer. Graham understood that some investors, captivated by the promise of high returns, will inevitably be drawn into speculation. That is why he advocated for rigorous evaluation, the margin of safety, and a disciplined approach to portfolio construction. Next, we will explore how Graham structured a portfolio to resist the siren call of hot stocks, balancing opportunity with security and ensuring that even in volatile markets, the defensive investor could sleep peacefully at night. By now, we understand why hot stocks are dangerous. But Graham didn't stop at warnings. He offered a methodical path forward, a blueprint for building a portfolio that could endure uncertainty while still producing respectable returns. He called this the defensive investor's approach, conservative, disciplined, and rooted in value. Graham emphasized the importance of balance. A defensive portfolio is not about chasing the highest returns. It is about preserving capital while earning a reasonable income. To achieve this, he advocated a mix of common stocks and high-quality bonds, not 50-50 by chance, but a thoughtful allocation, often between 50 to 75% in equities with the remainder in bonds. This proportion could shift over time, depending on market conditions, but the key principle was always the same: diversification and risk mitigation.
Within the stock portion, Graham favored companies that were well-established, financially sound, and, crucially, understandable. He encouraged investors to choose businesses whose operations they could comprehend, a principle that remains as relevant today as it was in the 1940s. No complicated financial engineering, no opaque conglomerates, no speculative ventures. Instead, focus on firms with steady earnings, manageable debt, and a history of dividend payments. Bonds, the other half of the defensive portfolio, served as a stabilizing force. Graham recommended high-grade, investment-quality bonds, ones that could provide a predictable income stream even during market turbulence. The goal was not to maximize returns, but to reduce risk, something many modern investors overlook in the pursuit of excitement. Another crucial element was the margin of safety. Each holding should be purchased at a price below its intrinsic value. Even if the market faltered or a company encountered unforeseen challenges, this cushion protected the investor from catastrophic losses. For Graham, the margin of safety was the linchpin of conservative investing. It is what distinguishes speculation from investment. Graham also introduced the concept of systematic review. A defensive investor does not set a portfolio and forget it. Instead, regular monitoring, rebalancing between stocks and bonds, and reassessing valuations were necessary. If a stock appreciated well above its intrinsic value, it might be sold, with proceeds redirected to undervalued assets. This disciplined approach reduces emotional decision-making and prevents the portfolio from drifting into speculative territory. Consider a modern parallel. Imagine an investor in 2025 allocating 60% to a mix of blue-chip companies with strong earnings and dividends, and 40% to high-quality municipal or treasury bonds. Over time, market fluctuations may cause equities to rise sharply, tempting the investor to chase further gains. But Graham would counsel restraint. Sell a portion of overvalued positions, reinvest in undervalued assets, maintain diversification, and focus on fundamentals. The goal is steady growth and preservation, not excitement. Ultimately, Graham's defensive portfolio is an exercise in patience and prudence. It is designed to shield investors from the whims of market hype, speculative mania, and psychological impulses. By emphasizing safety, quality, and systematic evaluation, the defensive investor can achieve returns that may not be sensational, but are enduring. Next, we will examine some historical examples from Graham's era illustrating how his defensive principles performed during the most turbulent periods, the stock market crash of 1929, the Great Depression, and the subsequent recoveries. These stories bring his methodology to life, showing not just theory, but practice in action. To truly appreciate Graham's wisdom, we must step back into the roaring 1920s, a period of exuberance and overconfidence. Stock prices had soared to unprecedented heights, and speculation was rampant. Investors poured money into hot tips and glamorous new companies, ignoring fundamentals. When the market crashed in 1929, fortunes evaporated almost overnight, and millions were left financially ruined. Graham witnessed this devastation firsthand, but rather than abandoning the market entirely, he studied it meticulously. He observed patterns in human behavior, fear, greed, and herd mentality, and how they amplified market swings. From these experiences, he distilled key lessons for defensive investors. One of his enduring observations was that markets are inherently volatile. Prices swing far above and below intrinsic value, not always due to changes in a company's business, but because of collective emotions. Defensive investors, he argued, must recognize this truth and prepare to act rationally, not react impulsively. Consider an example from his own investing during the early 1930s. Graham noticed that certain well-established companies, which had strong balance sheets and consistent earnings, were trading at prices far below their intrinsic worth. While the crowd panicked, he saw opportunity. By purchasing these undervalued stocks, he could build positions at a significant margin of safety.
This principle resonates even today. Think of market sell-offs caused by economic uncertainty or geopolitical tension. Often, the fundamental value of solid companies remains intact, but their stock prices plummet due to fear-driven selling. A defensive investor, armed with Graham's philosophy, doesn't succumb to panic. Instead, they assess intrinsic value, buy selectively when prices are attractive, and maintain discipline. Another lesson from this era was the danger of chasing returns. The speculative frenzy of the 1920s promised rapid wealth, yet it ignored risk. Graham observed that investors who sought quick gains often paid the ultimate price, losing both capital and confidence. In contrast, those who adhered to conservative principles, diversified portfolios, high-quality securities, and careful valuation, emerged relatively unscathed, even during extreme downturns. Graham also highlighted the psychological dimension of investing. Market crises expose the emotional vulnerabilities of investors. Panic can lead to selling undervalued assets, while greed can lead to buying overpriced securities. He urged the defensive investor to cultivate patience, detachment, and rational thinking. Emotional discipline, more than technical skill, is what separates long-term success from ruin. Finally, these historical lessons reinforce the importance of preparation. A well-constructed defensive portfolio, designed with intrinsic value and margin of safety in mind, acts as a buffer against market turmoil. Investors who follow Graham's approach are not immune to losses, but they are shielded from catastrophic mistakes that often befall the emotionally driven majority. Next, we'll explore the enterprising investor, those willing to accept higher risk for potentially higher rewards, and how Graham advised them to approach stocks and bonds differently, while still adhering to the principles of value and margin of safety. While the defensive investor seeks safety and stability, Graham recognized that some individuals possess the time, temperament, and skill to take a more proactive approach. He called these individuals enterprising investors, those willing to devote effort and analysis to uncover opportunities that the market may have overlooked. Graham emphasized that enterprising investing is not speculation. It requires rigorous research, discipline, and a commitment to fundamentals. The enterprising investor actively seeks undervalued securities, mispriced bonds, or companies temporarily out of favor. But unlike the gambler chasing trends, the enterprising investor relies on measurable, objective criteria: earnings, dividends, asset values, and financial health. For instance, during the aftermath of the 1929 crash, many smaller, less followed companies had been unfairly punished by panic selling. Graham often scoured balance sheets to identify firms whose intrinsic value exceeded their market price by a significant margin. These bargains required diligence and patience, but the rewards, measured in long-term returns, were substantial. Graham also cautioned enterprising investors against overreaching. He advised diversifying across multiple undervalued securities and avoiding concentration in a single stock or sector. Even a brilliant analysis can be undone by unpredictable events. Diversification reduces risk without diluting the potential for superior returns. Another key distinction lies in the use of bonds. While defensive investors often favor high-grade bonds for capital preservation, enterprising investors can take advantage of opportunities in lower-rated corporate bonds or special situations, provided they conduct careful credit analysis. Here, margin of safety is just as critical. Pay less than the estimated value to ensure downside protection. Consider a modern parallel. Enterprising investors today may research small-cap companies overlooked by the broader market, or identify industries temporarily depressed by cyclical trends. By applying Graham's principles, valuation, financial scrutiny, and patience, they can capture gains that the casual, defensive investor may miss, all while avoiding speculative excesses. Yet Graham warned that the enterprising path is not for everyone. It demands time, education, and an ability to resist emotional impulses. Those who lack these qualities may be better served following the defensive strategy, accepting slightly lower returns in exchange for greater stability and peace of mind.
Finally, Graham highlighted the importance of adaptability. Even enterprising investors must adjust strategies as markets evolve. Rigidity, overconfidence, or reliance on trends can turn a disciplined approach into speculation. The enterprising investor thrives not by chasing fads, but by understanding value, embracing patience, and respecting the unpredictable nature of markets.
Next, we will explore how Graham quantified the balance between stocks and bonds for both defensive and enterprising investors, a framework that remains relevant for anyone seeking to allocate capital wisely in uncertain markets. One of the central dilemmas for investors, Graham observed, is deciding how much of a portfolio should be in stocks versus bonds. This question is particularly pressing for the defensive investor, whose priority is preserving capital while still participating in the growth of the market. Graham's guidance was both simple and profound. Never overcommit to one asset class and adjust allocations according to market conditions and personal temperament. He recommended a framework. A defensive investor should generally maintain a 50-50 split between high-quality stocks and bonds. However, this ratio could be shifted moderately, never exceeding 75% in either direction. For instance, during periods when stocks seemed particularly overvalued or volatile, a defensive investor might tilt toward bonds, while during times of depressed stock prices, a greater allocation to equities could be appropriate. But this wasn't just about numbers. Graham emphasized the psychology of allocation. Stocks can offer higher returns, but they also bring volatility. Bonds provide stability, but often at the cost of growth. An investor who cannot emotionally withstand the swings of a predominantly stock portfolio may find themselves selling at the wrong moment, undermining long-term returns. By maintaining a balanced approach, one cultivates discipline and avoids succumbing to panic or euphoria. During the Great Depression, many investors who were heavily weighted in stocks experienced catastrophic losses. Bonds, particularly those of sound companies or government-issued, provided a lifeline, cushioning portfolios against total collapse. Graham noted that it is not enough to buy wisely. One must also hold wisely, maintaining an allocation strategy that can withstand the inevitable fluctuations of the market. The modern investor faces a similar challenge. Low interest rates, changing economic cycles, and technological disruption make the choice between stocks and bonds complex. Graham's principles endure. Evaluate the quality of each investment, understand the trade-off between risk and return, and avoid the temptation to chase recent performance. For enterprising investors, the balance can be more dynamic. They might increase stock exposure to exploit undervalued opportunities or purchase carefully selected lower-grade bonds for enhanced yields, always applying rigorous analysis to preserve the margin of safety. But even in these situations, Graham warned against abandoning diversification or chasing trends that feel too hot to ignore. Another key insight relates to market valuation. Graham suggested that investors could tilt allocations based on the relative attractiveness of the asset classes. If stocks are trading at extreme premiums relative to their historical earnings, a defensive investor might prudently favor bonds until valuations normalize. Conversely, if equities are deeply undervalued, stocks can offer opportunities for long-term growth without sacrificing prudence. Finally, Graham stressed that this balance is personal. Age, income requirements, investment horizon, and temperament all influence the optimal allocation. There is no one-size-fits-all prescription, but a disciplined approach, grounded in value and safety, ensures that decisions are thoughtful rather than reactive. Next, we will examine one of Graham's most important concepts for both defensive and enterprising investors alike, the margin of safety, a principle designed to protect investors from permanent loss while allowing for the pursuit of reasonable returns. If there is one principle that defines Benjamin Graham's philosophy, it is the concept of the margin of safety. This is the idea that an investor should always buy securities at a price significantly below their intrinsic value, creating a cushion against errors in judgment, market volatility, or unforeseen events. In Graham's words, the margin of safety is the central concept of investment.
Imagine walking across a bridge. You know it can hold 1,000 pounds, but you weigh only 150 pounds. You feel confident because the bridge can easily support you. Now imagine walking on a bridge rated exactly for 150 pounds. Every step is tense because there's no room for error. Investing without a margin of safety is like crossing that second bridge. One miscalculation, one sudden shift in the market, and the consequences can be catastrophic. Graham applied this concept rigorously during the turbulent markets of the 1920s and 1930s. After the 1929 crash, countless companies were trading far below their tangible assets or earning power. Those investors who understood and applied the margin of safety, buying stocks only when they were sufficiently discounted, were shielded from the worst of the devastation and positioned for recovery. The margin of safety isn't just about avoiding losses, it's about fostering discipline. It forces investors to be patient, to wait for opportunities that are truly favorable, rather than being lured by speculation or hype. Graham warned against emotional investing, where fear and greed override rational analysis. By adhering to a margin of safety, an investor protects their capital while retaining the ability to profit when the market eventually recognizes the intrinsic value of the investment. Consider a modern example. Suppose a company's intrinsic value, calculated from earnings, assets, and growth prospects, is $100 per share. A prudent investor, applying Graham's margin of safety, might only purchase the stock if it falls to $70 or $75. This cushion provides a buffer against mistakes in calculation, sudden economic downturns, or unexpected business challenges. Even if the company faces temporary setbacks, the investor is less likely to suffer permanent loss. The margin of safety also applies to bonds. High-quality bonds purchased at a discount or with strong interest coverage give a similar protective buffer. During the 1930s, many investors who bought government or well-capitalized corporate bonds at reasonable prices survived the Depression unscathed, while speculative buyers of overpriced securities were devastated. Graham's emphasis was always on rational analysis over hope or market sentiment. By building a portfolio with sufficient margins of safety, an investor can achieve steady, long-term growth without gambling on unpredictable outcomes. It is not a strategy for quick riches, but a methodical path to financial security and independence. Next, we will explore the psychology of investing, another cornerstone of Graham's teachings, and understand why even intelligent investors often make irrational decisions that destroy their portfolios. Benjamin Graham often emphasized that investing is not solely about numbers and calculations. It is just as much about psychology. He understood that human emotions, fear, greed, and overconfidence are perhaps the greatest threats to an investor's success. The market, in Graham's view, is a theater of human behavior, oscillating between euphoria and despair, often in ways that defy logic. Graham introduced the metaphor of Mr. Market to illustrate this concept. Picture a business partner named Mr. Market who shows up every day offering to buy your shares or sell you his. Some days he's optimistic, offering a high price. Other days he's pessimistic, offering far below value. His mood swings are unpredictable, and they are not a reflection of the true value of your investments. They reflect his emotional state. The key, Graham warned, is not to let Mr. Market's moods dictate your actions. When prices are irrationally high, resist the temptation to buy simply because everyone else is rushing in.
When prices are irrationally low, resist panic selling. Instead, approach investing with discipline, analyzing intrinsic value and maintaining your margin of safety. Buy when the price is below value and ignore the noise when it deviates from rationality.
Consider the 1929 crash again. Many investors, carried away by market euphoria, ignored warning signs and leveraged themselves heavily. When the market collapsed, fear took over, and panic selling destroyed fortunes. Meanwhile, disciplined investors who had kept emotion in check and adhered to Graham's principles were able to purchase quality assets at discounted prices, ultimately recovering and prospering in the following decades. Even today, markets are rife with hype cycles, hot stocks, and speculative bubbles. Graham's warning is timeless. The smartest investor is not the one who chases trends, but the one who masters their own psychology. Understanding human behavior allows you to remain calm during market chaos and to act when opportunities are truly favorable. Graham also cautioned against overconfidence. Many investors assume they can predict market movements or identify the next high-flying stock. But markets are inherently unpredictable in the short term. Overconfidence leads to excessive trading, speculation, and often loss. A patient, methodical approach rooted in analysis, margins of safety, and realistic expectations outperforms erratic, emotion-driven behavior over time. The practice of investing with a clear mind, free from emotional reactions, is challenging but essential. It requires self-awareness, discipline, and humility. By mastering the psychology of investing, you can turn volatility from a source of anxiety into an opportunity for profit. As we reach the final chapter of our journey through Benjamin Graham's wisdom, it is clear that his principles are not relics of the past. They are enduring guidelines for anyone seeking to navigate the unpredictable seas of investing. What Graham offered was not a formula for instant riches, but a philosophy for building wealth steadily, safely, and with confidence. At the heart of Graham's teachings lies the concept of intrinsic value. He reminded investors that the true worth of a business is grounded in its fundamentals, earnings, assets, and long-term prospects, not the fluctuating moods of the market. To invest wisely, one must carefully assess value, apply a margin of safety, and resist the seductive pull of hype. Consider the world we live in today. Technology stocks, meme-driven market frenzies, and speculative investment trends dominate headlines. It is tempting to chase the excitement, to seek the thrill of rapid gains. Yet Graham's lessons remain as relevant now as they were in the 1940s. Hot stocks, viral investment trends, or the latest guaranteed opportunity can be perilous. Without careful analysis and discipline, they often destroy portfolios rather than build them. Graham's advice for the defensive investor is simple, yet profound. Diversify holdings across high-quality stocks and bonds, maintain a balance that aligns with your risk tolerance, and never compromise on quality for the sake of chasing returns. For the enterprising investor, willing to invest time and effort, there are opportunities to identify undervalued stocks, securities, selling below intrinsic value, or neglected companies with strong fundamentals. Both paths require patience, rational judgment, and emotional control. Beyond techniques and calculations, Graham emphasized character and temperament. Successful investing is as much about cultivating patience, discipline, and humility as it is about analyzing numbers. Avoiding impulsive decisions, understanding your own psychology, and respecting the limits of your knowledge are pillars of enduring success. Reflecting on his life and career, Graham's legacy is profound. He weathered financial upheavals, taught generations of investors, including Warren Buffett, and distilled decades of experience into insights that remain actionable today. His teachings are a compass for those navigating markets that are ever-changing, noisy, and often irrational.
The actionable takeaway is clear. Approach investing as a craft, not a gamble. Focus on intrinsic value. Maintain a margin of safety, control your emotions, diversify intelligently, and resist the lure of fleeting trends. By doing so, you not only protect your wealth, but also create opportunities for steady growth. Graham's wisdom is timeless because human nature and the market's response to it remains constant. So, as you consider your own investment journey, remember the lessons we have explored: the importance of disciplined analysis, the dangers of speculation, the power of patience, and the necessity of emotional control. These are not just strategies, they are principles that guide you to think clearly, act prudently, and build lasting financial resilience. In a world obsessed with speed, hype, and instant gratification, Benjamin Graham's voice stands as a beacon of reason. His teachings remind us that true wealth is built quietly, steadily, and wisely, and that the investor who honors these timeless principles can navigate any market storm with confidence and calm. And as we close, consider this: the market will always present opportunities, but it will also always test your resolve. By following Graham's guidance, you equip yourself with a framework to make those opportunities count while avoiding the pitfalls that have ensnared so many. In the end, investing is not about chasing the next hot stock. It's about cultivating judgment, discipline, and a mindset that endures.